Hello my fellow freedom builders and welcome back to the channel. Today's video will be about interest rates. And yes, I know that might not sound like the sexiest topic in the world, but I promise you that when we have finished this video today, you will know more about interest rate and the effect on the stock market than 95% of all investors out there, and you can use that knowledge to make money or to prevent yourself from losing money. So listen to the end, watch it to the end. And oh, by the way, I have a little favor I'll ask of you. It seems like YouTube, for some reason, have been putting my channel back in the back of the queue. So if you would please hit that like button, maybe write a little comment what you think of the video, and all in all, just give the channel a bit of love. Then I hope YouTube will find its way to put us in the front of the line again. So if you want to make sure you see more of this content, do all the stuff below the video, like, subscribe, all that jazz. All right, back to interest rates. That is the juicy part. Now, every time Powell opens his mouth, the market moves. Now, why? Let's have a quick look at a slide here. When the interest rate is going up, three things happen, or actually a lot more, but I will focus on three of them, and actually mostly on the two here on the top when we are looking at today. So when interest rate goes up, it means that borrowing money becomes more expensive, but it also means that you can get more interest when you put your money in the bank. That is important knowledge. Now, if we take the lower point here first, because that is the one I will talk the least about today. Interest rates, when they go up, we have lower consumer spending. Now, that is logic for most people, but it basically means that if a consumer should go out and use a credit card, for instance, they might not buy just as much down in the store because that they know the interest rate on the credit card will be higher, or they might have some way of borrowing money in the house, the real estate they own. But because that the interest rate is going up, a larger percentage of their earnings are going to pay for their house, and therefore they have less to spend on groceries and stuff. So interest rate goes up means lower consumer spending. That part is fairly clear. But these two are definitely worth paying some attention to. And the first one here, I think, will be a bit of an eye-opener for many investors. Because lower PE ratios is the effect of higher interest rates. I'll have a look at just in a second why that is important. But let's just have a quick look here. And I know this can seem a bit like a spaghetti chart, but this is the S&P 500's PE ratio. So this is not the price of the S&P 500 index, but the blue line here, that is the PE ratio. I'll get back to PE ratios just in a second. But this is the PE ratio of the S&P 500, the average for the entire index. And this orange-brown line is the 10-year Treasury bond rate, meaning that when that is down here, it means that the bond rate, the interest rate in society is below 1%. So let's just get back to this blue line just in a second. I just want to make sure everyone knows what a PE ratio is, and a PE ratio is basically the stock price divided by the earnings per share. Meaning that if a stock costs $100 and the earnings per share in the company is $10, then the price earning is 10. That is how simple it is. It is how much money, how many dollars is an investor willing to pay for this stock for every $1 of profit. So a price earning ratio of 10 means that for every $1 of profit of earnings per share the company has, you are paying $10. So that basically means that if you're paying a price earning ratio of 10 for a stock, you just to find out what yield you get, what kind of interest you get from owning this company. You're taking 100, dividing by the PE ratio, and you get a 10% yield. If you buy a stock where the PE ratio is 20, you take the 100 divided by 20, and you effectively get a 5% yield. Now, it's not necessarily cash you get in your hand, but it is a profit that the company produces that they can pay out in dividends, or they can buy back their shares so the share price goes up, or maybe they can invest it in something like new research or whatever, so that the company you own a part of becomes even more profitable and wealthy. So basically, when investors are paying 20 in PE ratio, they're getting a lower yield. If they are buying a stock with a PE ratio of 5, they are going to get a yield of 20%. And you might ask yourself, well, then why are people not just only buying PE ratios of 5? Because who wouldn't want 20% in yield? But that is, of course, because no one knows what the future brings. So a PE ratio of 5 might be for a company where you're not completely certain about the future. Whereas the PE ratio of 20 or 30 or 50 or 100 is often, the higher the price earning ratio, it often indicates that it is some sort of growth company. Because you might think to yourself, why would anyone pay a PE ratio of 100 or 500 or 1000? Because that means they are almost not getting any yield on their money. And yes, that is correct right now, but the investor is expecting some future growth in the company. It could be with a little tech company or whatever. It could be Tesla that is trading at a PE ratio of 60 or 70 or more. And that is because people expect a lot of growth in the profit in the company. So it is getting a better and better investment for them. But that is important to understand, that the higher the PE ratio, the lower the yield. Let's get back to this chart, and we can see here that every single time the treasury bond, the interest rate in society goes up, then we see that the PE ratio goes down. So that when the treasury bond, the interest rates go up, the PE ratio drops. And we can see this effect. It's almost a one-to-one correlation or negative correlation. Treasury bonds go up, PE ratio goes down. Treasury bonds go down, PE ratio goes up. And that is, of course, because that when the treasury bond, when the interest rate goes up, it also means that you can probably put your money in the bank. You don't have to buy treasury bonds, but you can put your money in the bank and get a decent interest rate. Now, if you are buying a stock and there is a PE ratio of 20, let's say that means you're getting 5% yield. Now, if you can buy a bond at 5% yield as well, that means that you're getting a 5% yield on the stock with all the risk that comes with it. Of course, also potential growth, but the company could go bankrupt, or there could be competitors stealing some of the market, or there could be a ton of things happening. If you're buying a bond, almost nothing can happen. There is very little risk with buying a normal government treasury bond. So if you can get 5% yield on a bond, then why would you settle for a 5% yield on your stock? So investors are saying, oh, now we can get a higher yield just buying bonds. Well, then I want 10% to own the stock because I get more risk owning the stock. The second the investors are wanting more yield on their stocks, that drops the PE ratio, because then they can't pay a PE ratio of 20 anymore. They have to lower it to 10 and say, I'm not buying this stock before I can get it at a PE ratio of 10, because that gives me a yield of 10%, which is double the percentage I can get in the bond. And that is what I want for taking the risk in the stock. I hope that makes sense. So every time interest rates go up in society, we see that the price earning that investors are willing to pay goes down, meaning that they want a higher yield. So you might think to yourself, is that really so important? And let me try and show it to you here in my stock scanner. I have taken Microsoft Corporation. We all know that one. It's a good and solid company, and it will probably be around for many decades. What I have put in here is I've taken the estimates from the analysts here, and I've said that after the next couple of earnings, we have put a 10% growth in earnings per share in. So that's a good and decent growth. I have also put the price earning to 34, which is about where it is now. And knowing the formula from before, we know that 100 divided by 34 gives approximately 3% in yield for owning Microsoft right now. Now, if the yields on bonds are staying high and people are saying, I'm not too certain about the future, a lot of things can happen, so I'm actually not willing to pay a price earning of 34. I'm only willing to pay a price earning of 20. If we put that in here, 20, we can see that over the next 5 years, we go from a CAGR before at almost 10%, 9.9% per year, to a CAGR that is negative of minus 1.5%. So it might be, we can try and go back to the 34 here, and we can see the 9.9% in CAGR. You might think that the earnings growth here is the most important thing in how much Microsoft will grow. Let's try and bump this down to only 5%. And we can see, yes, your earnings, if the price earning will stay at 34, then you'll make roughly 7% per year. But that is with half the growth in earnings. The really important trigger here is what happens if price earning drops to 20 or 15 or even lower. That will mean a massive drop in the Microsoft Corporation stock here. So when we're looking at the spreadsheet here, sorry, not the PowerPoint slideshow here, we can see that it actually makes sense that the stock market is getting under pressure when the interest rate goes up. We have seen a long period with dropping interest rates. Now, I don't have the latest interest rates on this, but you know it very well. It is now up at 5.25%, and that means that people can get a lot of yield just buying bonds. And that also means that the price earning will be pushed way down, and that can put a lot of stocks under pressure. Now, let's go back to this one, because this was the lower PE ratios. Now, this one is also important, lower corporate profits. And I have found a report here that I want to show to you, which is here. And I know these reports can sometimes look a bit dull, but this is the title, End of an Era: The Coming Long Run Slowdown in Corporate Profit Growth and Stock Returns, by a guy named Michael Smolyansky. I didn't know him before this, but this is actually a very good and thorough report. What he's writing is that he can show that the lower interest expenses and corporate taxes that the company has had from 1989 to present day around 2022 actually mechanically explains 40% of the real growth in corporate profits we've had the last 30 years. What he's saying here is that the main reason, the main driver for the companies producing a lot of profit the last 30 years, and therefore the stock price is going up, is actually that our interest rate has dropped and that the tax rate has dropped. This is in the United States. Now, the good question is, if that is true, then if we are going to see higher tax rates and we are going to see higher interest rates, then that will cut a lot of the corporate profits away. So is that realistic? Well, let's have a look at it. If we go down here to page 3, and I will link to this report below the video if any of you feels like reading it. But what he can see is that from 1989 to 2019, the real corporate profits, and when he writes real corporate profits, it's the profits when you have deducted the inflation rate. So the real corporate profits grew at a robust rate at 3.8% per year. That is, of course, 3.8% plus the inflation rate that has been deducted here. So 3.8% is quite robust. That was almost double the pace that was seen from 1962 to 1989. So the fact that the interest rate actually dropped from the 80s and onwards have accounted for a lot of the extra profit these companies have made. If we go down to this graph here, we can see that the corporate interest rates went up from 62 back up until the beginning of 80s, and then it started to drop. And what this Smolenski, the economist here, is saying is that this explains about half of all the growth in profits in the companies back from 89, late 80s, and then to 2022. Now, can we expect higher interest rates in the future? Well, I think we can safely say yes here. It might not be as high as it is now, but it is definitely not going to be zero as it has been for a very long time. I think we actually have it here. Yes, we have the Fed funds rates here. You can see them here, compare them to the S&P 500, and you can see from back in the 80s it dropped, went up, dropped, went up, dropped, went up, and dropped, and stayed after the financial crisis at a very, very low level. Then the Fed tried to hike them, or they did hike them from around 16, 17 here, and then for some strange reason they dropped them, kept them at zero again, and now we are at a point where it really, really hurts. So the Fed fund rates up here, as we said, it is pushing the price earning down, and it is pushing definitely the corporate profits down, because they have to pay more and more and more to borrow the funds they need. And we can see, if we just take a quick look at it, here at ARK Innovation, the ARK ETF, and this is not to hit on them, but it's just because this ETF is completely stocked with companies that would be called high growth companies. They are borrowing, not all of them, but many of them are borrowing a lot of money, and that was great. It went up like crazy when the interest rate was zero, but then it started to, we could understand with the inflation coming up and everything that of course the interest rate would also come up. And that means that the price people were willing to pay for the stuff that was in the ARK ETF, it dropped. They were simply willing to pay a lower price earning, which in these cases meant a lot. Also, many of these companies had borrowed a lot of money, so with higher interest rates, their profit simply dropped like a rock. Then, of course, there was the thing that many of these stocks also benefited from the Corona shutdown. Some of them did anyway, where everything should be online. So that was another factor that pushed this down. But the main drivers from the ARK Invest going from 160 and down to 27, 29 at the lowest down here is primarily that the companies are making less because they're paying higher interest rates, and that the investors are willing to pay a lower price earning. That is the major driver, the price earning. So what you should be thinking when you hear about higher interest rates or lower interest rates, then you should think, how does that affect the price earning that people are willing to pay? How does that affect, if we just take a quick look at the slide here, how does that affect the price earning investors are willing to pay? How will it affect the company's overall earnings? And we can see when we go into something like Microsoft here, for instance, we look at the summary, and you can go down and see down here almost at the bottom you can find the interest coverage. That tells you how many times it can pay its own interest payments with the earnings per share it has. So a company like Microsoft can easily sustain some higher interest rates because that wouldn't kill them completely. They would have less money, of course, for research and marketing and everything, but they are well off here. There are many of the companies, for instance on the ARK ETF, that have a negative interest coverage. So they're not even making enough money to pay zero interest rate when it was at that. And now that we have a lot higher interest rate, then it has really, really gone the wrong way. So an interest coverage at 10 or 20 or even 45 as here, that is a very, very secure stock. And of course, it also depends on is it long-term or short-term debt and so on. But returning to the slide here, we had the lower PE ratios, we had the lower corporate profits due to higher interest payments, and then of course you should also consider, if the interest rates are going up, how does that affect the customer of this company? Is this some customers that are not affected in any way by higher interest rates? Then it might not really affect the purchase of this company's product. But if it is, for instance, a normal private consumer, and you can see that this exact type of consumer will be severely hit by higher interest rate, well then that is also a piece of the puzzle. I hope this makes sense and that you see the logic is in why higher interest rates give us lower PE ratios, and why lower PE ratios is one of the massive drivers to lower stock prices. And also the lower corporate profits, that is a big part of it, but the real major player here is that the investors are willing to pay lower PE ratios. That is what hurt the stock prices the most, and not necessarily a bit lower profits. If it did make sense, if you have any questions to it or comments, leave it in the section below, in the text section below the YouTube video. And remember to like and subscribe so that YouTube can see that this is actually a channel that someone is willing to look at. Until next time, take care of yourself and your money out there, and I'll talk to you again shortly. Bye.